Chapter 5, Variable Costing, a Tool for Management. This is from Garrison, Noreen, Brewer, Cheng, and Wan. The learning objective in this chapter will be how to understand variable costing, and then how it differs from absorption costing, and the way to compute unit costs under each method. There are two general approaches used for valuing inventories and cost of goods. So these two approaches will be discussed in great detail in the next few minutes. One approach is called absorption costing, and it's generally used for external reporting purposes. The other approach is called variable costing and is preferred by some managers and used only for internal decision making, and must be used when an income statement is prepared in the contribution format. So we're going to discuss these two methods over the next couple hours. Here's an overview of the two costing methods. Absorption costing on the left, variable costing on the right. Top lines are the same, sales. Bottom lines are the same, net operating income. But you'll see in between there are differences. Absorption costing again is GAAP and can be used outside the company. Variable costing is only used inside the company and is the key part of managerial accounting. So absorption costing, or full cost method, treats all costs of production as product costs, regardless of whether they are variable or fixed. So there's no distinction made between variable and fixed costs. Absorption costing is not well suited for cost volume profit computations. Under absorption costing, the cost of a unit of product consists of direct materials, direct labor, and both variable and fixed overhead. Variable and fixed selling and administrative expenses, such as period costs, are then deducted from revenue as it's incurred. Variable costing, which is also called direct costing or marginal costing, treats only those costs of production that vary with output as product costs. So this approach dovetails with the contribution approach to the income statement or profit and loss statement, and supports cost volume profit analysis because of its emphasis on separating variable and fixed costs. That's the key. Variable costing separates variable and fixed costs and emphasizes this. The cost of a unit of product consists of direct materials, direct labor, variable overhead. Fixed manufacturing overhead and both variable and fixed selling and administrative expenses are treated as period costs and deducted from revenue as incurred. So think about the impact of each method on inventory values. And then let's answer the next couple questions. Which method will produce the highest values for work in process and finished goods inventory? Recall which method includes more manufacturing costs in the unit product cost. And the answer is absorption costing or full cost method will always have the highest value for work in process and finished goods inventories. Okay. So let's take an example. Harvey Company produces a single product with the following information. Harvey Company creates 25,000 units per year. The variable cost per unit will be $10 for direct materials, direct labor, and variable manufacturing overhead, and $3 for selling and administrative expenses. Those are the variable costs. The fixed costs per year are $150,000 for manufacturing overhead and $100,000 for selling and administrative expenses. So the unit product cost is determined as follows. Here we have absorption costing and variable costing, two columns on the right. The direct materials, direct labor, and variable manufacturing overhead is the same under both costing methods. $10 under absorption costing, $10 in variable costing. The fixed manufacturing overhead, we will take $150,000 divided by the annual production of 25,000 units. So the unit product cost under absorption costing, you can see here, includes the fixed manufacturing overhead, and because of that it has a higher unit product cost. So under absorption costing, all production costs, variable and fixed, are included when determining the unit product cost. Under variable costing, only the variable production costs are included in product costs. Quite a difference. Now, our second learning objective. Let's prepare an income statement or a P&L statement using both variable and absorption costing. So let's assume the following. Harvey Company makes or sells 20,000 units during the year at $30 a piece. There's no beginning inventory. So now we're going to compute net operating income using both absorption and variable costing. Under absorption costing, we start always the same. Here's your P&L. Sales on top, 20,000 units were sold, $30 a piece, gives you $600,000 in sales. Now, let's subtract, again, absorption costing, full cost method, beginning inventory at 0, add the cost of goods manufactured. So we made, remember earlier, 25,000 units times $16 a unit, $400,000. Gives you goods available for sale. Beginning inventory is 0 plus 400,000 gives you 400,000 available for sale during the period. And then inventory was 80,000 units. Okay? You made 25,000 units, you sold 20,000 units, you had 5,000 units remaining, ending inventory. Therefore, $320,000 is your cost of goods sold, fully loaded, fully absorbed. Gross margin is $280,000. Now we incurred selling and administrative expenses. The variable portion, $3 times 20,000 units, $60,000. Fixed expenses, fixed portion of selling and administrative expenses is $100,000. So these two combine to $160,000. Subtract that from the gross margin, gives you a net operating income of $120,000. Remember that. Bottom line, top line, fixed manufacturing overhead, deferred in inventory is $5,000. 5,000 units times $6, $30,000. That's going to be deferred. And deferred means it'll be recognized later. Okay? So under variable costing, we do a little different. Same with the sales on top, 20,000 units times $30, $600,000 in sales. That's the same as the other method. Now we're only going to take the variable expenses, and that'll give us a contribution margin. So instead of $16 per unit, $10, only the variable portion of manufacturing. Alright, so and our inventory will be 5,000 units. We made 25,000, we sold 20, ending inventory is 5,000. So our variable cost of goods will be 200,000. Variable selling and administrative expenses will be 60,000. Total expenses, variable expenses, 260,000. Subtract that from the 600,000 in sales, gives you a contribution margin of $340,000. Now, take away the fixed expenses. Manufacturing overhead, all manufacturing overhead is expensed, all of it. And selling and administrative expenses, 100,000. 250,000 is the sum of these two, and we take that away from the contribution margin, gives us a net operating income of $90,000. And what was it in the previous one? Hold on. Under absorption costing, $120,000, because $30,000 retained in inventory, but in the direct costing method, net income is less. Back this up. So let's compare the two. Variable costing versus absorption costing. Then the bottom lines, and explain why they differ. Absorption costing, variable costing. Cost of goods sold is different under the two methods. Cost of goods sold shows 320,000, whereas under variable it's only 200. So let's reconcile the variable costing and the absorption costing methods and look why they differ, how much they differ. So absorption costing method on the top, variable costing on the bottom. You can see that the cost of goods is significantly higher in absorption costing because fixed manufacturing costs are included in cost of goods sold. Ending inventory includes fixed manufacturing costs. It does not have any fixed manufacturing costs in the ending inventory. Why? We expense all of the fixed manufacturing costs as a period expense under costing. Therefore, in this example, the totals are the same. However, one has got a period expense, one has got an ending inventory expense. Now, variable costing net operating income is 90,000. There's a difference. 120,000 is the net operating income under the full absorption costing method. Why is that? Why is it higher under absorption costing? Because all of the fixed manufacturing overhead costs were expensed in the variable costing method. There's more downward pressure on net operating income. Remember, $6 a unit. That's going to be sticking in your inventory for unsold units if you use absorption costing. That's the difference. So, number of units produced, 25,000. Number of units sold, 30,000. It's the same under both methods, of course. Units in beginning inventory, 5,000. Unit sales price, $30. Direct materials, $10. Variable, Selling and administrative, $3. Variable. Manufacturing overhead, fixed, $150,000. Selling and administrative, $100,000. Now we're going to look at it in year 2 and see what. So, again, direct materials, direct labor, variable overhead, $10 and $10, the same under both methods. However, here's the difference. Fixed manufacturing overhead is $6 in absorption. Since the variable cost per unit, total fixed costs, and the number of units produced remained unchanged, the unit cost computations also remain unchanged. Now, full absorption costing, here we see the results. 30,000 units times $30 gives us $900,000. We're going to subtract cost of goods sold. It's fully loaded. 25,000 units, cost of goods manufactured. We had a beginning inventory of 5,000 units available for sale. Gross margin, $420,000. Now we take away variable and fixed selling and administrative expenses, $190,000. So net operating income will be $230,000. Again, 5,000 units is in inventory, brought forward, beginning inventory. Under variable costing, we use the variable expenses here, fixed here, and all fixed manufacturing overhead is expensed in the period. It's a period expense. So beginning inventory will only bring in the variable cost portion because we expensed the fixed in the previous period. Add cost of goods manufacturing, but only the variable, $10 a unit. Goods available for sale, variable cost of goods, variable selling and administrative, so this portion is all variable, gives us a contribution margin. So $390,000 is our variable expenses, gives us a contribution margin of $510,000. Take away the fixed expenses, $250,000, net operating income, $260,000. So now let's reconcile the two. Variable costing, the net operating income is $260,000. Taking away the fixed manufacturing overhead, $30,000. That's the difference. So the net operating income in the second year is higher than it is in the net operating income for the variable costing is higher than the absorption costing in the second year, because in the first year we expensed fixed manufacturing overhead. So let's compare the two. In the first period, the net operating income was higher for absorption because we didn't sell all the units, we kept some in inventory. It was lower for variable. But in the second period, net operating income was higher with variable expense method. But in the two periods combined, it works out to be the same. So over time, it is possible that the cumulative effect is the same. However, good managers want to know period by period the effect. So here's the summary. When it comes to the relation between production and sales, the effect on inventories, and the relation between variable and absorption costing. Consider it over the 2 years that Harvey's company operated. When units produced equal units sold, the two methods report the same net operating income. When the production equals the units sold, there's no change in inventories. Absorption equals variable. The two methods are the same. But if units produced are greater than units sold, absorption costing is greater than variable costing because we keep some of the fixed overhead expenses on the balance sheet as inventory. If units produced is less than units sold, inventories decrease. So the variable costing method produces a higher net operating income. Moving on, learning objective number 4. The advantages and disadvantages of both methods, variable and absorption costing. Opponents of absorption costing argue that shifting manufacturing overhead costs between the periods can lead to faulty decisions. Okay. These opponents argue that the variable costing P&L statements are easier to understand because net operating income is only affected by changes in unit sales. This produces net operating income figures that are consistent with managers' expectations. So some people support variable costing, some people support absorption costing. Now, CVP means cost to volume profit analysis, decision making versus absorption costing. Absorption costing doesn't work well with CVP analysis. CVP analysis looks at variable versus fixed. Nor does absorption costing support the good decision making. It treats fixed manufacturing overhead as a variable cost. It assigns per unit manufacturing overhead costs to production. Treating manufacturing overhead as a variable cost can lead to faulty pricing decisions and faulty keep or drop decisions. And assigning per unit manufacturing overhead cost to production can potentially produce positive net operating income even when the number of units sold is less than the break-even point. So, external reporting and income taxes. Practically speaking, absorption costing is required for external reports in the United States and other countries that follow IFRS. In many countries, including the United States, a form of absorption costing must be used when filling out income tax forms. Top executives are typically evaluated on earnings and that are reported to shareholders in the external reports, and they feel that decisions should be made on absorption costing data. So again, absorption costing data is GAAP and then used for published financial statements, and that's where top executives tend to be compensated. There are many advantages of variable costing and the contribution approach, but this is not GAAP and can only be used inside the company. The data required for cost volume profit analysis can be taken directly from a contribution format P&L statement. Profits move in the same direction as sales, assuming other things remain the same. Managers often assume that unit product costs are variable costs. Under variable costing, this assumption is true. Fixed costs appear explicitly on a contribution format statement, thus the impact of fixed costs on profits is emphasized. Variable costing data make it easier to estimate the profitability of products, customers, and other business segments. Variable costing ties in with cost control methods such as standard costs and flexible budgeting. Variable costing, net operating income, is closer to net cash flow than absorption costing, net operating income. So, with all of these advantages, why is absorption costing so prevalent? Well, one reason, in addition to this requirement for external reporting, relates to the matching principle. Proponents of absorption costing argue that it better matches costs with revenues. They tend to state that fixed manufacturing costs are just as essential to manufacturing products as are the variable costs. But advocates of variable costing view fixed manufacturing costs as capacity costs. They argue that manufacturing costs would be incurred even if no units were produced. So we're at different opinions. So let's move on. Variable costing and the theory of constraints. So companies involved in theory of constraints use a form of variable costing. However, one difference of the TOC method is that it treats direct labor as a fixed cost for three reasons. Although direct laborers are paid on an hourly wage, many companies have a commitment, sometimes enforced by labor contracts or by the law, to guarantee workers a minimum number of paid hours. Number two, direct labor is usually not the constraint. Therefore, there is no reason to increase the number of direct laborers. And three, theory of constraint emphasizes the role direct laborers play in driving continuous improvement. And since layoffs often devastate morale, managers involved in theory of constraints are extremely reluctant to lay off employees. So what is the impact of lean production? When companies use lean production, the goal is to eliminate finished goods inventories and reduce work in process inventory to almost nothing. This causes absorption costing and net operating income to essentially move in the same direction as sales. Therefore, the difference between absorption costing and variable costing income tends to disappear. So if there's no inventory, there's no fixed overhead cost sitting in inventory. It's learning objective number 5. Computing determined overhead rates, and we'll explain why estimated overhead rates rather than actual overhead rates are being used in the costing process. Why use an allocation base? Manufacturing overhead is applied to all products and jobs that are in a process. We apply overhead using a base we believe causes overhead costs to be incurred. Some companies allocate manufacturing overhead instead of using direct labor hours or machine hours. We must allocate overhead costs to products and jobs for a variety of reasons. First, it is difficult, if not impossible, to actually trace overhead costs to particular products and jobs. The cost of grease for machinery, for example, to manufacture our product is part of our manufacturing costs. It would be impossible to accurately trace the amount of grease consumed to manufacture one unit of output. Manufacturing overhead also includes a number of different costs, and it would be very difficult to gather all of them together in time to charge them to a particular product or job. A product or job may be complete and sold before we can determine the actual overhead costs incurred. And finally, many types of overhead are fixed in nature, even though output fluctuates during the period. So manufacturing overhead application. To facilitate the allocation of manufacturing overhead to each product or job, we calculate a predetermined overhead rate before the period begins. The rate is calculated by dividing the total estimated manufacturing overhead for the coming period by the estimated total units of the allocation base. If our allocation base is machine hours, we would estimate the total number of machine hours used in production in the coming period. Ideally, the allocation base should be a cost driver because it causes overhead to be incurred. Predetermined overhead rates that rely upon estimated data are often used because actual overhead rates for the period are not known until the end of the period. Thus, it inhibits the ability to estimate products and job costs during the period. And two, actual overhead costs can fluctuate seasonally, thus misleading decision makers. The predetermined overhead rate is calculated using a three-step process. First, we must estimate the level of production for the period. Next, we estimate the total amount of the allocation base in the denominator that would be required for that level of production. Third, we estimate the total manufacturing overhead costs in the numerator that would be incurred for the estimated amount of the allocation base. So the predetermined overhead rate is calculated by dividing step 2 by step 3. Predetermined overhead rate. Now, under the normal costing system, we calculate the predetermined overhead rate before the period begins. As we work on a particular product or a particular job, we apply overhead by multiplying the predetermined rate times the actual level of activity. Overhead applied equals production overhead rates times actual activity. If overhead applied on the basis of machine hours, we would apply overhead by multiplying the predetermined rate by the actual number of machine hours used on a particular job or product. So, predetermined overhead rates are equal to the following. Recall the equation for calculating the predetermined manufacturing overhead rate. There it is. The overhead can be allocated on the basis of direct labor hours worked on a particular product. And in the example with Harvey Company, Harvey's predetermined overhead rate was $3 per direct labor hour. Assume it takes 2 direct labor hours to complete a unit of product, so it applies $6, which would be $3 times 2 hours manufacturing overhead cost to each unit of the product. At Harvey, each product will be charged $6 of overhead for each hour of direct labor worked. So in order to match the earlier figures in Harvey, we further assume that variable manufacturing cost is 0. So the predetermined overhead rate represents only fixed manufacturing overhead rate, matching information on the earlier slides. Learning objective number 6. Let's understand the implications of basing the predetermined overhead rate on activity at capacity rather than on estimated activity for the period. There are two major criticisms of calculating the predetermined overhead rate based on estimated amounts. The first is that the predetermined rate creates problems when actual levels of activity are different from estimated or budgeted amounts. The second is that in some cases, basing the predetermined overhead rate on estimated amounts charges products for costs that they do not use. We can minimize the criticisms by basing estimated total units in the allocation base at capacity levels of activity rather than the estimated total units. So let's look at the difference. Let's take an example. Equipment is leased for $100,000 per year. Running at full capacity, 50,000 units could be produced. The company estimates that 40,000 of units will be produced and sold next year. What should be the predetermined overhead rate? Okay, well, the equipment's leased for $100,000, running at full capacity. 50,000 units may be produced. The company estimates 40,000 will be produced and sold. So, under the traditional method, the denominator is 40,000 units. The numerator is going to be $100,000, $2.50 per unit. Under the capacity method, the denominator is different. It has 50,000 units. Traditional method, it has 40,000. So it's $2 per unit. So let's take a quick check. Here we've got a vineyard in Australia. Barossa Winery in Barossa Valley, South Austria. Australia leases an automatic corking machine for $100,000 a year. At full capacity, it can cork 50,000 cases of wine per year. The company estimates that 40,000 cases of wine will be produced and sold next year. What is the predetermined overhead rate based on the estimated number of cases of wine? Well, this is good. $2.50 per case. Although it was circled over A, the answer is actually B. How do we do that? Well, that was that. The previous one was that, the estimated number of costs. Now we're going to do the capacity method. Okay. Under the capacity method, it's $2 per case. When capacity is used in the denominator of the predetermined rate, what happens to the predetermined overhead rate as an activity decreases? Well, the capacity number is larger. Right? So the overhead rate will be less. Predetermined overhead rate stays the same because it's not affected by changes in activity level. Right? When estimated activity is used in the denominator, what happens to the predetermined rate as estimated activity decreases? Rate goes up when activity goes down. Now, let's look at the income statement under a capacity method. Okay? Under the capacity method, there's 50,000 units. Predetermined overhead rate will be $2 a case. Then we can identify the cost of idle activity, idle capacity. Critics usually suggest that underapplied overhead that results from idle capacity should be disclosed on the income statement as the cost of unused capacity. And you disclose it as a period expense. So look at the P&L statement here using the capacity approach to calculate the predetermined overhead rate. The disclosure of $20,000 of cost of idle capacity that is recorded as a period expense. this cost is incurred because we were not able to fully utilize our capacity. So using a measure of capacity in the denominator of the predetermined overhead rate enables this type of disclosure. This truly helps us in decision making. Now, here's the income statement using the traditional approach. Notice that the cost of goods sold is charged the cost of idle capacity using the estimated or budgeted amount of the allocation base in the denominator of the predetermined overhead rate calculation does not allow for the disclosure of the idle capacity down here. In this example, underapplied overhead is not treated as a period expense, but instead it's allocated to the work in process, finished goods, and cost of goods sold. Learning objective number 7. Compute underapplied and overapplied overhead costs and prepare journal entries to close the balance of the manufacturing overhead to the appropriate accounts. There's problems of overhead application. When we apply overhead on the basis of predetermined overhead rate, it's likely that the amount of overhead applied will be different from the amount of overhead actually incurred during the period. And when there is a difference, we refer to the amount as either underapplied overhead or overapplied overhead. Underapplied overhead exists when the amount of overhead applied to products or jobs during the period using the predetermined overhead rate is less than the total amount of the overhead actually incurred during the period. Overapplied overhead exists when the amount of overhead applied to products or jobs during the period using the predetermined overhead rate is greater than the total amount of overhead actually incurred during the period. So we either underapply or we overapply. So recall the example that we had with Harvey. Assume that Harvey Fresh incurred actual overhead of $120,000 during the period and worked a total of 50,000 direct labor hours. Harvey Fresh applies overhead at the rate of $3 per direct labor hour worked, which is $6 per unit. How much overhead did Harvey Fresh apply to the products during the period? Now you see it. Harvey Fresh would have applied $150,000 of overhead during the period. Why? $3 per direct labor hour times the 50,000 direct labor hours actually worked, which is $6 per unit for the 25,000 units produced. You can start to see the problem. Harvey Fresh has actually overapplied the overhead. The difference between the overhead costs applied to work in process and the actual overhead costs of the period is termed underapplied or overapplied overhead. Harvey Fresh incurred actual overhead of $120,000 and then applied $150,000. So the company overapplied $30,000 of overhead for the year. So how do we dispose of this overapplied overhead? Okay, let's do a quick check. A different company, Tiger Limited, had actual overhead costs of $1.2 million and a predetermined overhead rate of $4 per machine hour. Tiger Limited worked 290,000 machine hours during the period. Tiger's manufacturing overhead is $50,000 underapplied. Here's the calculation. $4 per hour, 290,000 hours gives you the overhead applied. Underapplied overhead $50,000. So how do we dispose of under-applied or over-applied overhead? There are two good ways to dispose of it. The more complex approach is to allocate a portion of the over-applied or under-applied overhead to work in process, inventory, finished goods, and cost of goods sold. The allocation would be based on the relative dollar value in each of the three accounts involved: work in process, finished goods, and cost of goods sold. Or the easier way would be to deal with this problem is just have an adjustment to cost of goods sold for the entire amount of the over or under applied overhead. This is the easier method. Using T accounts, you can see it a little better. Harvey Fresh has applied $150,000 of overhead but incurred only $120,000 of overhead. So the manufacturing overhead account has a $30,000 credit balance, representing the over-applied overhead during the year. Harvey Fresh chooses to adjust cost of goods sold for the entire amount. The adjustment necessary at the end of the year is to debit the manufacturing overhead account for $30,000 and credit or reduce cost of goods sold by the same amount. If under or over applied overhead is adjusted through cost of goods sold directly, then it will appear under cost of goods manufacturing to make the fixed manufacturing overhead agree with the actual expense. So in this case, $30,000 was deducted from cost of goods manufactured to reduce $150,000 applied overhead to the actual expense of $130,000. So let's assume at the end of the period, Harvey Fresh applied $150,000 overhead costs in each of the following accounts: work in process 0, $30,000 to finished goods, and $120,000 to cost of goods sold. We could elect to allocate the over or under applied overhead to ending work in process, ending finished goods, and cost of goods sold. So we will allocate $30,000 of over-applied overhead proportionately, resulting the reduction of ending work in process inventory by $0, finished goods inventory by $6,000, and cost of goods sold for the period by $24,000. A journal entry to record the allocation is a debit to manufacturing overhead for $30,000 and a credit work in process inventory of $0, credit finished goods inventory for $6,000, and credit cost of goods sold for $24,000. The under or over applied overhead can also be adjusted through the proportional allocation method. On the surface of the P&L statement or the income statement, an adjustment can be shown under ending work in process and finished goods inventory. Total over-applied adjustment, in this case $30,000, will be shown under cost of goods manufactured instead of the expected $24,000, because we need the $30,000 to deduct the amount carried under ending inventories to get the net result of $24,000 remaining in COGS. So in this case, the $30,000 over-applied adjustment minus $6,000 over-applied to ending finished goods, giving us the expected $24,000 adjustment for cost of goods sold. So using the proportional method normally will generate a different profit figure from the direct written off from COGS. In this case, the difference is 6,000. It's not significant, so it's 150,000 versus 144,000. So let's go back to where we were. We're going to be asked to allocate the over or under applied overhead. Okay. The relevant figures are shown. Work in process, 20,000, finished goods, 30,000, cost of goods sold, 50,000. So how much should the over or under applied manufacturing fixed overhead be adjusted to the finished goods if the proportional allocation method is used? $15,000 more. If the overhead adjusted to cost of goods sold, if the proportional allocation method is used, $25,000 more. Okay, now let's explain the potential problems of using absorption costing. Extra profit can be created without additional sales within the absorption costing framework. Additional profit can be created by producing extra inventory. So you can see where $60,000 of extra profit was created by increasing production of 10,000 units of inventory. Okay. Harvey Fresh's actual fixed manufacturing overhead was $120,000 in this example. And based on the original scenario, the applied overhead was based on actual production of 25,000 units at $6 each. That gave rise to $150,000 being applied to the items produced. Therefore, it was over-applied by $30,000. How was that calculated? The $150,000 applied versus the $120,000 actual. The $30,000 over-applied needs to be adjusted to match the actual fixed manufacturing overhead. So based on the new scenario, the applied overhead was based on actual production of 35,000 units, giving rise to $210,000 being applied to the production. Therefore, it was over-applied by $90,000. The $90,000 over-applied needs to be adjusted to match the actual fixed manufacturing overhead. So profit arising from inventory, ending inventory value. The additional $60,000 is a profit, is the same amount as the additional over-applied adjustment, so $90,000 minus $30,000. The over-applied adjustment is to make good of the applied fixed overhead to match with the actual overhead spent. So the additional profit actually arises from the additional fixed overhead based on the predetermined overhead rate, or POHR, carried forward through the change in the inventory, amounting in the same as the over or under applied fixed overhead adjustment. If the adjustment is done through the proportional method, then the increased profit will not match the over applied adjustment. Let's see it here. Additional inventories produced receive additional fixed manufacturing overhead based on the predetermined overhead rate, not based on the total increase in the ending inventory value. So the variable costs associated with additional inventories are net off by the increase in the production cost in the ending inventory. The additional fixed manufacturing overhead created here reduces cost of goods sold by the same amount, giving rise to the additional profit that matches the under or over applied adjustment. So comparing the net operating income arising from absorption costing method and the variable costing method, we would find that the difference is the same under the over and the under applied overhead adjustment. Thus, there were no change in the net operating income, regardless of production and ending finished goods quantity, proving that variable costing is the technique for management to ensure no profit inflation can be done through producing more inventories. Using variable costing to compute the net operating income on production of 25,000 and 35,000 units produces the same figure of $120,000 when the sale and cost structures in both scenarios are the same, providing support to the concept. We have provided a good study aid for dealing with over-applied or under-applied overhead. We've shown the impact of both the allocation approach to the solution to the problem and the direct adjustment to cost of goods sold approach. Alternative 2 is considered more accurate, but is more complex to apply. So, what effect will the over-applied overhead have on Harvey's net operating income? The net operating income will increase. Right? We have assumed that the company has used one single predetermined overhead rate for the entire factory. Many large companies use multiple predetermined overhead rates. Using multiple overhead rates can create more complexity. However, the use of multiple rates promotes greater accuracy in the allocation process because it reflects the differences across departments in how overhead costs are incurred.